There is a standard answer to the question in this video, and you have probably heard that answer dozens of times. Yes. Historically, the S&P 500 has always delivered around 10% per year. Invest, wait, and do not interfere. This answer is not wrong, but it is incomplete in a way that could be costly for those investing today without understanding what has changed. Because the S&P 500 of 2026 is not the same instrument as it was in 1990. Its internal structure has fundamentally transformed, and most people investing in this index simply do not know this. In this video, I will show exactly what has changed, why this matters for your portfolio, and how you can make a more rational decision without hype, without catastrophizing, and without the easy comfort of ready-made answers. But first of all, if you don't know me yet, I am the digital avatar of Brian Mercer. I was created to share with you the scripts and teachings that Brian himself develops, including while he organizes the details of his next international journey. Our goal is to provide the tools for you to enhance your personal and financial growth. Brian monitors and reads all the comments, so we would love to hear your opinion down below. When you buy an ETF that replicates the S&P 500, you assume that you are acquiring a slice of the 500 largest companies in the United States. This is true, but there is a critical detail in how this index is constructed. It is weighted by market capitalization. This means that the largest companies receive a disproportionate weight in the index. And today, this imbalance has reached a historic level. The so-called Magnificent Seven, which are Apple, Microsoft, Nvidia, Alphabet, Amazon, Meta, and Tesla, currently represent about 33 to 35% of the entire index's market capitalization. This is only considering these 7 companies. To provide context, the capitalization-weighted S&P 500 index has outperformed its equal-weight version by the largest margin in any 3-year period since 1971. And what does that mean in practice? When you buy the S&P 500 today, you are not buying the American economy. You are largely buying a concentrated bet on a very specific group of technology and artificial intelligence companies. In 2025, approximately 42% of the total return of the S&P 500 came from the Magnificent Seven. This concentration is a fact, not an opinion, and any honest analysis of is it worth investing in the S&P 500 needs to start here. Before any hasty conclusions, it is important to look at the fundamentals. The market did not rise over the last 3 years by accident. The S&P 500 delivered a total return of 26% in 2023, 25% in 2024, and over 18% in 2025. This is an exceptional performance by any historical metric, and there is a real earnings base behind these numbers. For 2025, S&P 500 companies reported year-on-year earnings growth of 12.4%. For 2026, analysts project growth of 14.7%. The resilient growth prospects for profits in 2026, the possibility of additional interest rate cuts, and the neutral positioning of institutional investors support the likelihood that the market will continue to rise. Goldman Sachs, for example, projects earnings per share growth of around 7% per year in both 2025 and 2026. The consensus among leading Wall Street strategists points to an index level between 7,000 and 8,100 points by the end of 2026. The average projections among the main investment strategists point to the S&P 500 at 7,555 points by the end of 2026, with implications of a 9% increase from current levels. So the fundamentals are in place. Profits are growing. The American economy is still expanding. The labor market, although slowing down, remains historically strong. So far, the narrative of the S&P 500 is consistent. But there is another side to this equation, and that is where the analysis needs to be more careful. Risk 1. What is valuation? The index is expensive. It's not alarmism, it's data. The Vanguard S&P 500 ETF is trading at 28 times earnings. This is one of the highest levels in the last 100 years. The Shiller-Cape ratio, which measures inflation-adjusted valuation over 10 years, is above 40. The index has only been in this territory once before in history, on the eve of the dot-com crash in 2000. This does not mean that a correction is imminent, but it does mean that the margin for error is narrow. When you buy assets at high valuations, you increasingly rely on everything continuing to work as expected. Profits growing, interest rates falling, consumption holding up, stable geopolitics. Any relevant negative surprise in any of these variables could result in disappointing returns over an extended period, even without a dramatic collapse. Risk 2. Concentration as a volatility amplifier. This is the least discussed risk and the most important to understand. When a small group of companies dominates the index, the decline of these companies drags everything down faster than a broad-based sell-off would. It's not theory. In the first 2 months of 2026, the S&P 500 rose by only 0.5%, even as the Magnificent Seven collectively lost 5.1% of their value. This divergence begins to signal a possible rotation of capital, but it also demonstrates how the index responds asymmetrically to what happens with a very small group of stocks. Today, the 10 largest companies in the S&P 500 represent approximately 39% of the total market capitalization of the index, well above the 27% reached during the peak of the tech bubble of 1999 to 2000. Risk 3: the cycle of artificial intelligence. A large part of the recent valuation is built on expectations of returns from artificial intelligence. The largest technology companies had approximately $400 billion in capital expenditures in 2025, nearly 70% more than in 2024. The market is betting that this massive investment will translate into exponential profit growth. This bet may be correct. However, the return on this capital has not yet been fully demonstrated, and when the market starts to demand payment for this, history shows mixed results regarding the success of pioneers during periods of significant technological innovation. So is it worth investing in the S&P 500? The answer depends on three variables that only you know: what your time horizon is, your actual capacity to tolerate volatility, and what you expect this investment to do for you. If you have a horizon of 10 years or more, and you can hold the position without redeeming during periods of severe downturns, the historical answer remains favorable. Time continues to be the most valuable asset for the passive investor. Every new all-time high has been preceded by a previous high. An all-time high is not a sign that prices are out of control. In fact, it is a sign that the market is pricing in a positive future, and highs tend to follow one another. However, if your horizon is shorter, or if you are investing a significant portion of your capital now in a single contribution at historically high valuations, you need to be more cautious with your expectations. What makes sense to consider? Firstly, the equal weight S&P 500 offers a less concentrated alternative. While the market capitalization weighted S&P 500 delivered a total return of 86% between 2023 and 2024, its equal weight version delivered 43% in the same period. In a high concentration environment, the equal weight version performed worse. However, it tends to perform better when the cycle reverses and market leadership broadens, which is what several strategists expect for 2026 and beyond. Secondly, regular contributions, such as dollar cost averaging, continue to be mechanically superior to lump sum contributions during periods of high valuation. You reduce timing risk, average out the acquisition price, and remove the emotional burden of the decision. Third, geographical diversification is worth revisiting. The American market lagged behind Europe and other regions for a good part of 2025. A portfolio excessively concentrated in the S&P 500 carries the same concentration risk that we criticize within the index itself, just on a larger scale. The S&P 500 continues to be one of the most efficient wealth accumulation instruments available to the long-term investor. This has not changed. What has changed is that buying the index today requires more awareness than buying the index did 20 years ago. You are not buying 500 companies with balanced weights. You are buying an index that, structurally, is a concentrated bet on a group of technology companies that need to deliver extraordinary returns to justify their current valuations. This can happen. There are strong arguments that it will happen. But the investor who understands this mechanism makes better decisions about the size of the position, about the pace of investment, about the need for complementary diversification, than the investor who has only heard that the S&P 500 always goes up. Information does not eliminate risk, but it improves the quality of the decisions you make with it. Now, I want to know your opinion in the comments. Is it risky to invest in the S&P 500 in the current scenario of 2026? And if this video helped you in your investment development, like this content so I can create more topics like this. And don't forget to subscribe to the channel. See you later.